Good morning. I just wanted to do a quick video for all of you based upon what has been a pretty turbulent sort of 6 months now, year to date, hasn't it, within equity markets. And what we really want to look at is how the world might have changed, where we would invest now, and what we can really learn from the last 6 months. It is obviously always important that we're learning from what's gone on in the past. And so, has the world changed and has it materially impacted the way we invest? Well, you know, if we look at things like Zoom and Teams, then have platforms such as that significantly impacted our working practices? I would say that it probably has. I mean, I've worked from home a lot more. I know a lot of my clients have worked from home a lot more, and in a lot of sectors, obviously not all industries, but in a lot of sectors, business productivity hasn't been impacted that much. So perhaps things like Zoom and Teams will allow us to connect and communicate more efficiently going forward. Consumer spending habits, how have they changed? You know, if you want to buy something, where's the first place you go to now? Maybe 8 months ago it was the shop. Perhaps that's no longer the case. Maybe it's now Amazon or another online platform, Ocado for food, or Gibson's, or whatever the case may be. So perhaps consumer spending habits have changed and will never go back again. Who knows? Potentially offices and the traditional office space for a lot of industries is a thing of the past. Maybe we now look at shared working areas and that sort of network of everything and all, only paying for an office space when we actually need to use that office space rather than having a 12-month contract or whatever the case may be. I know there's a lot of firms now looking at that and wondering whether they need the 12-month rental lease, etc. So potentially that's something that might change going forward. Only time is going to tell with all of those things, right? But it's definitely something to consider. And when we're looking at portfolios, maybe we should be taking more of an interest in things like cybersecurity, robotics and automation, fintech, and those sort of thematic elements of a portfolio that may have been overlooked previously. 2020 so far has seen huge market movement. You know, the FTSE 100 is down sort of 20% year to date. Euro Stoxx 50 down double digits. S&P 500 has just broken clear and in positive space, although we still sit around about 1% from the February high. It's been a choppy ride. Tech stocks generally have carried the market through this, and now within the US you look at the S&P 500 and you've got only 5 companies accounting for about 20% of that entire index. Those 5 companies have had a great year. How's the year been for the other 495? Probably not so great, right? So we now need to look at the construct of indices and figure out whether that's actually where we want to be putting our money now. Maybe we now look to a mutual fund or a fund manager who can select stocks within that index and possibly reduce risk by being able to do that. Gold has had a phenomenal year, up 35%. The alternative currency, the flight to safety, the printing of so many trillions of dollars in a lot of people's eyes, making inflation an inevitable consequence to come in 1, 2, 3 years, whatever the case may be. So, does gold still have legs? You'll all know by now that I try not to make too many market predictions or time the market, but I think it probably does, based upon the arguments that we just gave. So, what are the 4 key things we should take away from 2020 so far? 1, learn. Learn from the last 8 months. Learn from 2020 and learn how it made you feel. If you had a portfolio, if you'd invested in February, £100,000, whatever it was, and it dropped to 20% to 80,000 or lower, how did you feel? Were you a medium to long-term thinker who was confident that it would just come back anyway? Did you close your eyes and say, I'll open them again in a year and have a look then? Or did it really make you feel like you couldn't sleep at night? Because if it's the latter, then maybe you need to do something about that. So that leads on to point 2, review. You should be constantly reviewing your portfolio anyway and looking at whether it needs rebalancing, but use opportunities like this to review. Do you need to change the makeup, the structure of that portfolio going forward because of the way that it reacted or behaved in the last 6 to 8 months? If it didn't make you feel confident, if you lost sleep at night, then you potentially need to reduce volatility there and accept that you may, not necessarily, but you may also materially impact long-term growth, but that's okay if you feel more comfortable throughout the investing process. So where do you go now? Where do you invest now? The answer's never been any different, has it? Have a well-diversified portfolio. Try not to read the news too much and make decisions based upon that, because we all know what that leads to. And make sure that you've got the portfolio structured in such a way that it's going to take you through. So that's point number 3. Where now? It's the same answer as ever. It's always going to be well diversified, in line with your own risk profile. That is your capacity to take risk, as well as your appetite for that risk. And it's that appetite that you'll have learned about in the last 6 months, that feeling. That's the bit that you need to look at. Point number 4, don't waste opportunities. It's easy to say now with a little bit of hindsight, but it looks like maybe we have a second wave in 2 months, 3 months, and markets go down again. I don't know. But right now it looks like 2,300, 2,400 on the S&P 500 was an opportunity. Every textbook that you'll ever read about investing will tell you that the best time to put money is when there's blood on the streets, you know? But when the market falls from its February the 19th high to its, I think it was March 23rd low, do you have the confidence to put your money in? We should always be keeping a bit of powder dry, and we should always have the confidence to take advantage of opportunity. History teaches us that markets eventually recover. So don't ignore 20, 25, 30% falls. If we get those 4 things right, then hopefully going forward, we'll be able to sleep a bit easier if we haven't been able to sleep easy in the last 6 months, and still get that steady, medium to long-term growth, which is what this whole process is all about. Have a good week.